really want to get into CMHC with you because you're somebody I have a ton of respect for in the CMHC world. You and Josh are at the top of the game in that world.
I think if CMHC wasn't around, like the multifamily construction side would have just kind of completely collapsed over the last couple of years. There's definitely benefits and pros to using CMHC from like a debt structuring wise. On the flip side, it is a pretty tedious process,
and it's all your fault. You're the broker,
I know,
right?
I know. We put together the document list. We decided to ask for all this stuff. MLI, when it first came out, it's funny because even CMHC really underestimated how many people were going to be using the program. They thought it was going to be like 25% of their book. It's like 90% plus of their book, right? And CMHC really is the saving grace on the multifamily side right now.
What strategies are working really well in real estate right now? And how does that tie in with specific financing products? Hey, I'm here today with Ehren Laycock. We're going to dive into CMHC financing, MLI Select, multiple facets of financing economies, investor changes, all those different types of things. So make sure to stay tuned. We're going to dive right in. All right, Ehren, let's dive in here. Before we talk about, we're going to get into a bunch of CMHC stuff. We're going to, obviously you're a very well-respected mortgage professional, so we want to dive into some finance strategy, state of the economy. But just go back, introduce yourself to the viewers. Who's Ehren? What's your background? How'd you get into real estate investing? How'd you get into becoming a mortgage broker? What's the background?
Yeah, started out in university in kinesiology, so it wasn't anything financial from that respect. But our old business partner for Josh and I, when we were kind of first out of university, looking what we were going to get into, he was in the mortgage space. Shadowed him for a little bit, saw what it was like, got our mortgage licenses, started into that, and we actually started out more on the kind of commercial, alternative, semi-private side before we actually really got into the bank side. So we were exposed to that piece a little bit early, which was kind of unique for us because it was more problem solving up front first than like the firefighter school teacher, here's your Scotiabank TD mortgage, right? So right. I think we kind of learned to think of things a little bit differently before we got into the simple stuff. I think that kind of helped us with our growth. But I've had my license now for 6-7 years. We opened up Build Financial, or what was like the Finley Mortgage team, back in 2020, which was a pretty unique time given where COVID was and then the rate environment. We started doing our content back with like Matt McKeever and them 2020 as well too, and that whole kind of like ecosystem of the content coming out and talking about investing strategies and stuff like that, and then the rate market just absolutely tanked, and you were getting sub 1% insured homeowner rates. You were getting pretty cheap investor rates as well too, and that whole thing kind of just like spurred our business, and it took off from there, and it's been crazy ever since like 2020. I mean, you're in the industry as well too, so as well, but yeah, it's gone by so fast the last 5 years, and to where we are now. We've funded over $1 billion. That's
with a B.
That's with a B. Yeah. So it's been a crazy adventure that way with our growth. We starting out with investors and seeing the growth there, where people would hit their 5-10 unit portfolio, kind of max out, start looking for alternative solutions. We start to utilize some small commercial stuff to help there. And then just seeing investors starting to get into the commercial, units, the 5+ multifamily, some mixed use stuff, seeing the potential there in the underwriting and how that whole transaction would, be processed, and then comparing that to the residential space, and just seeing how much more, I don't want to say like easy, but it's a lot more just like common sense on the commercial side, where the numbers work or they don't work. And there's a couple solutions you can do to get the numbers work, but the asset has to fit financially and fit that qualifying. Where on the residential side, you're jumping through a bit more hoops. You can buy properties that don't necessarily cash flow, but you can make up for that with your personal income. And that was fine when the rates were okay, but when the economy went through some turmoil and rates shot up, we quickly saw how many properties really weren't actually debt servicing their own mortgage payments, and that just became a stressful situation for a lot of investors, and a lot of guys were bleeding. A lot of guys had to sell off their portfolio. Where on the commercial side, you're debt servicing that property from day one with bank debt. If it doesn't debt service, you're not getting the loan. So to see the benefits and how that stuff was structured, we really gravitated to that pretty quickly. And I mean, that's obviously taken off as well too. Again, just people moving away from the more residential portfolio and getting to that, and the emergence of CMHC financing, you know, coming out of that high interest rate debt. Because in like 2021, 2022, we were, you know, underwriting multifamily at like 3.25, 3.5 non-insured. And then a year and a half later, you know, it was like 5.5 to 6%. Was trying to take out those projects, and people had no choice but to start to get into the CMHC. MLI Select emerged around that time too. 50-year AM, 95% leverage. People in the mid space love leverage, so they saw that, and that took off. And now, you know, MLI Select is everywhere everywhere you look on Instagram, right? You got realtors who are specializing in MLI. You got purpose-built developments specifically for MLI. It's everything's MLI these days. So that's kind of like a quick 5-year amalgamation.
Yeah, $1 billion worth of funding in the last 5 years. I want to go way back on that, but I love it. Is interesting to see realtors specializing their sales practice on a financing solution. That is it makes sense because it's an investment package that's sold based on it, so it makes sense. But let's kind of go back to 5 years ago, 2020. It's the heyday, right? It's you throw a dart at the board, you're a real estate genius, you're making money. The 5-year jump, let's go slow in 21, 2022, 2023. How has that changed? What are the strategies that worked then that don't work today? Tying to financing, slow that 5 years down a little for us.
I think, you know, if you go back to when rates were super cheap, 2020, 21, I guess up into maybe 2022, part of that. If you're looking at from the res side, where people were really starting to grow that portfolio, it was almost impossible to not get financing. Because if you understand how it worked, there was still stress tests then, but you were stress testing off of like Bank of Canada, right? So you're 525 then. Every single deal was stress testing at 525 because the plus 2% was way below that, right? So it was plus 2% or 525. So you were stress testing a Scotiabank TD deal at the same stress test as you were with one of these alternative B lenders, Equitable Home Trust. So you had, you know, 50%, you know, rental inclusion with 30, you know, 35, 42, you know, whatever, 44% TDS, right? 30-year AM. And then you had B lenders that were stress testing at like 95%, 100% rental offset inclusion, 40-year amortizations at the day, 50, 60% extended debt ratios, business for self loans. It was like, well, okay, Scotiabank is, you know, 2.5%, but would you be okay paying 3% on the B side with some fees? Oh yeah, that's fine. Worst case, I'm like, okay, well, there you go. And it was quite literally almost impossible to not be able to finance a deal on the res side. Like, you know, you had to have like quite literally no down payment, no income, and a 200 credit score. And even then you could probably borrow some money and figure out a way. So, you know, that time there when you, just to see how easily those residential properties were getting debt service and approved, like everyone was buying and everything made sense. You know, your rates were low enough that even on the B side with 3% and the extended AM, you were still cash flowing, you know, maybe $500, $600 to $1,000 a month. Rent wasn't as high as it was, but the payments were just significantly lower. Housing prices were a bit lower back then as well too. So, you know, that whole kind of like, you know, storm just made for the perfect reaction. And everyone was growing their portfolio. I think the majority of people we saw had somewhere between 5 to 10 properties, or that was at least their goal, and they were getting pretty close to that. You know, we had res guys buying 2-3 properties a year, growing the portfolio. And again, they were all debt servicing. And you take a look at that, and taking a look at the terms they were taking, you know, 3-year terms, 2-year terms, 1-year terms, because those were the cheapest rates to be able to get in. They would do their BRRRRs and then they would try to get out, right? Because BRRRRs that was the big thing back then. Well, in 2 to 3 years, we hit that, you know, COVID hit. We got done with, you know, the cheap money pumping. Interest rates went up 3-4%, whatever it was, right? 400%, getting into the 5s. And there was a lot of individuals that were getting out of those BRRRRs, and just getting caught in that interest rate movement. And, you know, they were able to manage it. Maybe they were bleeding 100, couple $100 a month, or maybe they were just cash flowing a couple $100 a month. But when you take that over an entire portfolio and you start to be, short $1,000 a month across like 5 or 6 properties, I think that's where it really started to catch up with people. There was a lot of newer investors back then that got into flipping, made a couple $100,000 on a flip, or maybe they were into like wholesaling. They made a wholesale fee and it was, 100,000, 50, and they were like, that's it, this is my new job, I'm quitting. Which was always a bit of a mystery to me, because I'm like, your one thing that's allowing you to do well in real estate is you have a job. Now you're quitting that job and you have no, verifiable income. Those guys are back to work now, obviously, right? They're became a lot of mortgage brokers, a lot of realtors, or they just went back to whatever profession they were into. And that's okay. There's nothing wrong with that, right? I mean, things change, but
well, Ehren, let's camp out on that one for a second, because that's been the theme. We launched The Hard Truth about a year ago, maybe a little bit less than that. And we're not bringing out people on the show who have got themselves into trouble and are no longer in the business.
Yep.
So we're bringing on the people who have lasted. And the common theme is everyone has a job. I don't have any full-time investors.
Yeah.
They've all built real businesses. They have a designation, a license, a credential that they've used to help build and earn income. They didn't flip a house and quit their job. They're using the profits from their earned income to invest in real estate. And that's been kind of a theme that we didn't really plan on. It's just been kind of the realization that the full-time investor, make a wholesale deal, it's not sustainable. You need an earned income strategy.
Yeah.
Right? Yeah. So interesting you say that. We've seen a lot of it. We've seen the carnage that comes from that. Yeah. So, anyway, so the BRRRRs, people getting caught in higher rates, all that. Yeah.
I think I think there's a very select few that really make it as a full-time, real estate investor. But even then, most of those guys are probably large corporate REIT type structures, and they've taken it to a different level, not just I own 10 properties or whatever it is, 200 doors, like something like that. You do have to have definitely some supplemental income coming in on the side to help.
Let me challenge just the word full-time investors. I don't think there's any full-time investors. There are people who own successful real estate companies. But typically they have a property management element to that. They have a construction element to that. They have a large bankroll of cash that they're lending, but they're not a full-time investor. They own a real estate company.
Yeah.
Right? That they do full-time. So you just the scene and the word of I'm a full-time investor. Well, either you have a successful real estate business or you don't.
Yeah. If you wanted to break down like a full-time investor, you're probably broke running around to all your different properties, fixing toilets in the middle of the night, doing all your own, construction, renovations. That's not where you want to.
You're not a full-time investor. You're a property manager. You just work for yourself.
Yeah. It's a more attractive version of property manager.
Exactly. So.
Yeah.
Cool. So, all right. So that's 2023. Things are the rates go up. People are getting caught in BRRRRs. For the most part, back in 2023, most of the people, we weren't seeing too much carnage from that. They just couldn't get out. They had to sell. They lost their profit. We've seen some worse things happen since then. Talk to us about. I really want to get into CMHC with you, because you're somebody I have a ton of respect for in the CMHC world. You and Josh are at the top of the game in that world. What strategies are working really well in real estate right now?
Yeah.
And how does that tie in with specific financing products?
Yeah, CMHC, the benefit of CMHC in general is a few things, depending on how you want to look at some of them. But obviously, to those that need higher leverage, that's it. That offers you the highest leverage you can get, right? You're up to 95% of your construction costs, or up to 95% of your purchase price. So there's no higher leverage than that. It's going to offer you your most competitive rates on the market right now, right? Based on the CMB, some of the big banks do based off of GOC if they have access to that.
So for some of our CMB
and CMB, your Canada Mortgage Bond, so that's the bond specific to CMHC pricing. Your GOC is your Government of Canada. Basically, the big banks get access to GOC. The non-banking institutions get access to the CMB. So it was created for them for that. If you're above $3 million, $4 million in loan size, you're going to be around 4%, 4.25%, or less on the larger loan. So I mean, you're still in a really good rate position compared to credit unions, non-CMHC stuff. You're probably low to mid fives with a 30-year amortization, 25-year amortization. CMHC, you can get up to a 50-year amortization, which, yes, it extends your loan out obviously, but it does help to reduce your monthly payment, helps with your cash flow, makes your payments a little bit cheaper. Debt servicing wise, when we actually figure out how to qualify a building, your CMHC standard, you're qualifying at a 1.2, 1.3, but on the MLI Select, you're at a 1.1, which is obviously advantageous as well too. You can take on more debt at a lower debt servicing, factor in lower rates, higher amortizations. It's a perfect little storm for to qualify for a higher leverage deal. And I think it's been saving. I think if CMHC wasn't around, like the multifamily construction side would have just kind of completely collapsed over the last couple of years. We're already seeing new developments. Up until now, on the purpose-built side, it was they were down, right? I mean, condos definitely aren't being built. That's not with CMHC, but it is just in the space in general. Assets being traded again, like I just don't think the volume and the transactions would be there without CMHC, because it just doesn't qualify at the loan to value that the average mid-sized investor would want. So there's definitely benefits and pros to using CMHC from like a debt structuring wise. On the flip side, it is a pretty tedious process.
And it's all your fault. You're the broker,
I know,
right?
I know. We put together the document list and we decided to ask for all this stuff. It's being insured by a government program, right? And anything that goes through the government, it's difficult. It's challenging to deal with. And I think too, like you have to remember, CMHC themselves, most of these hires, and I can't obviously confirm this personally, but I mean, I assume most of these hires that go in through CMHC, they're pulling through government websites, they're pulling through inter-department transfers. I don't think they're going out there and looking for like top PE type analyst guys that are going to be able to sit down and analyze a deal and go through. They're not doing that like a bank is. They're hiring guys, they're saying, here's the policy, they're going through the steps, and they're just following, the book. And that makes it a little bit more challenging as well too, because sometimes you get one underwriter from CMHC that says something, you get another underwriter from CMHC that says something else. And that just also leads to kind of the confusion that you get on Instagram, where one guy gets this and hey, this guy got that and I can't get this. I'm being told I can get this, and it is different sometimes depending on who the underwriter is, and it's unfortunate.
Well, you're dealing with the rule is the A students work for the C students and the B students work for the government.
Yeah.
So you got a B student.
Yeah. So there's challenges with it. Timelines, they've gotten a lot better at it, but if you're submitting during a holiday season, like during the summertime, like these guys get 7-8 weeks of vacation, so they're taking a lot of vacation during the summertime. They're taking a lot of vacation over the Christmas holidays. So if you're submitting a deal in those two time periods, be prepared for some extensions. We don't always get notified when an underwriter that's working on a deal goes away. We'll just stop hearing for a couple of weeks, and then all of a sudden they're back, right? I had a file where the CMHC underwriter went on maternity leave and the deal wasn't passed off. They just disappeared, and then like a couple months later, all of a sudden we heard back and it was like, okay, file has been picked up now. And that was during the time where like 9 to 10, 12 months was like hey, this is possible for your CMHC timeline. It's a lot better now. But I mean, like, to kind of take a step back, like pros and cons of CMHC. The pros are the structural financing. The cons is just the process and the due diligence. There's a lot that goes into it. Proving net worth can be challenging for some individuals now that they've changed the way that you have to be able to show your assets. It's no longer just owned across multiple corporations. It's subject corporation and personal assets. You have to be able to prove the value and stuff like that. But again, like to my point, it's saving.
It's not 2008 anymore. They're going to look under your skirt and see what's there.
It's not, yeah, and like to be able to get this type of structuring, and I think people forget too, like. As much as CMHC is used now by everybody on all types of loan sizes, I've done loans as low as like $850,000 with CMHC. It's not recommended, but sometimes it's the only exit for some of these individuals. This financing was really meant for top tier institutions, REITs, guys that are taking on large construction or just large like portfolio debt, and they need to be able to make it manageable, right? And now you're taking this high level institution product and you're applying it to, a mid-level investor market, and it's, we're trying to fit it together as best as we can, and there are a lot of mid-level newer investors that are able to handle it, and they understand it, and they make it quite easy. And then there's some that do struggle with it a little bit, but they're really taking this product because there's just nothing else to be able to get them, out of that situation. And even with kind of all the fiascos and prom note and borrowed debt that we were seeing over the last few years, there still is a lot of that going on. And I think that's, it's always going to be there, right? It's fine as long as both sides are doing all their due diligence and they understand the risk. But when it comes from like a borrower standpoint, like it's your job to be able to make sure you can get all that money back to them. And in today's market, taking that 95% option is really the only way for them to be able to get all that money back and back to the investors. So CMHC really is the saving grace on the multifamily side right now.
There's three things you mentioned in there that I want to hit on for a sec. The number one thing that I'm going to tell the viewers to help out my CMHC broker friends is if your file is in submission and your underwriter goes on vacation, you don't want it picked up by somebody else, because it actually creates more confusion. Like I've heard clients say, well, get them to have another writer step in, wait for the week vacation, get your underwriter back, otherwise you're going to start a whole new process with a whole new someone else. So I hear that all the time, and I want to give you a break on that, because I know that side of it. Second thing, I want to talk MLI versus standard. The other thing I want to talk about is you touched on, and that's the smallest CMHC loan size I've heard. 2 million, under 2 million is tough on CMHC. Talk to us about options, because I haven't heard anything under $1 million, and you said 850.
Yeah, it was 850 around there. I mean, look, your CMHC's fees and everything, not CMHC themselves, but a CMHC deal, everything fee-wise and rate-wise, it's all set by the lender, right? Like CMHC will agree to the premium structure in terms of how low it can go, right? There is a minimum to how high above the CMB you can go. But the lender fees and your premium on the CMB, it's all set by the lenders, right? Like if you look at CMHC's website, I think they say like as low as 500,000 or something like that, or it's just like a minimum 5 unit plus. Like if they don't really specify that. Now, the caveat that they are making some policy changes where they're trying to deleverage, but that's kind of a different conversation. But yeah, it's up to the lender with how small of a loan they want to do. Your big guys, your big banks, your First Nats, your CMLSs, like they're going to have minimums, right? And it's usually around 3 million for a non-construction deal. If you're getting into CMHC construction, the minimums are a lot higher for most lenders. Most guys want to see around like 8 million and above. We are seeing some stuff getting done around like 4 and 5 million. Some guys are kind of creeping down into that like $2 to $3 million. The credit unions, the credit unions can be really good for that as well too. Just depending on how busy they are, which has been quite insane lately. But yeah, you can do smaller $1 million, $1.5 million, $900,000. You're just gonna be paying a premium for it, right? Like you're gonna be CMB plus like 2.5. You're gonna have, a 1% lender fee on there because they're not making as much money on the loan size and the interest payments, so they're gonna have to make their money on the transaction. So you're gonna pay for it. I don't recommend it unless it's, hey, like I'm going bankrupt or I have to refinance my property, right? If it's one or the other.
I guess the other scenario would be is they really want to hold this long term.
Yeah.
Like if you're thinking I might flip this building in 2 or 3 years, it's probably not worth it. But if they're like, no, this is like I'm holding this forever. Yeah. Then it might be more justified to go through the legwork to get.
Yeah. It was a pretty. Like it was a smaller town in BC. The property just debt serviced very well. Like even at that leverage, like he was still in like a 1.4 debt servicing. So I mean, there was still lots of cash flow there on the property. He had some other business transactions that he was trying to get through, and he just needed as much cash as he could get. And he had a property that had really like no debt on it. And he's like, this is my solution. We ran the numbers, the debt servicing was still super high, 1.4 is pretty strong. So, it made some sense in that situation. But, if you're looking at some of these other properties like on the MLI Select side, you're taking a 95%, let's assume it's loan to value because that's higher than loan to cost. Now the CMHC premium changes where like the MLI Select was at like 2.55%. You could be 5.36, or close to 5.5 now in your insurance premium on top of a 95% levered property. Like you're pushing the maximum debt on here to, close to like full property value.
With the house's money.
Yeah. You remember the 1.1 debt service on MLI does not include your insurance premium, and now you're getting like a mid-5 depending on your debt servicing on top of that. So, that 1.1 debt service, which used to debt service at like 105 on a 2.5 insurance premium, is now probably debt servicing closer to like break even on a 5-ish% insurance premium. So your cash flow at the end of the day, there's really not much left there when you factor in the insurance premium on the high, on the high leverage, right? You're really just trading equity back for a property that's going to manage itself and not really put much back into your pocket, especially when you're looking at like the 8-unit buildings, right? Which are huge and they do make some sense, but depending on where you're at with your leverage, like you may be making like $5,000 a year on this property. Now you're gonna get the equity increase and all that stuff. Yep, sure, and there's different strategies, yeah. But on the smaller ones, like at the end of the day, you really do run down that debt service. Now, I mean, the mid-sized investor strategy is, well, I'm gonna have 30 of these, and then now I'm making $150,000 a year. Yep, I get that. But again, it's just some stuff to keep in mind for sure.
I feel like this is starting to change. But it almost was like there was a time when MLI Select came out that it was like, almost like lower status if you didn't go MLI Select. Like, oh, you went CMHC standard. I feel like that's changing a little bit because there's a time where standard just makes more sense. Yeah. So I guess give us some examples of that and why you would recommend standard over MLI, because it has started to change. But a year ago, I could feel like, well, if I'm not doing MLI, I'm not going CMA. Like there was like this status thing. So what are some good reasons why standard makes a lot of sense to?
Well, I mean, like, it's funny when MLI came out, obviously the loan to value was there, but even on the construction, when like the mid-sized missing middle was really getting popular the last couple of years, it was, 95% loan to cost. It's like, well, if you read the standard CMHC outlines, it goes up to 100% of loan to cost. I'm like, it's always been higher and better from like day one, but no one ever really talked about it. Right. Now, who's getting 100% loan to cost? Maybe a nonprofit with pure affordability, 2,000 points and everything, like a fictional situation really. But MLI, when it first came out, it's funny because even CMHC really underestimated how many people were going to be using the program. They thought it was going to be like 25% of their book. It's like 90% plus of their book, right? And maybe I'm just, crazy, but when I see 95% leverage, 1.1 debt service, 50-year AM, 2.5% insurance premium, I'm like, why do you assume this is going to be such a low piece of on your book of on the insurance side? Like, I would assume everyone's going to want this financing. But again, I think that's the difference where what CMHC's original thought process was institutional level investors who don't want to leverage the shit out of everything, right? Yeah. Like they want to have some room there for their investors and their shareholders, and it's got to meet their own like investment and offering memorandum. So their mindset is different, where they weren't expecting the mid-level volume to come through, where the mid-level guy is, hey, I only have so much money and I have to be able to make it here to provide for my family and whatnot. I need to leverage as much as I can to grow as much as I can. And I don't think they were really expecting that side to come over. Right. And that mid-level to higher end level investor, I think, is really where we saw a huge amount of volume come in, and it kind of blew that out of the water. But that, I think, mixed with Instagram and social media, you get one guy that talks about a 95% project, low rates, high amortization. Another guy hears it, project. It's all over social media. I think that really spurred the growth. And I think the way investors kind of have used the program, we've seen the responses from CMHC in terms of I don't know if you want to call it pushback, but just policy changes in general, right? Over the last 2-3 years, we've had 6-7 policy changes. It first started out with, I gotta try to remember them all, but it first started out with some loopholes on the energy efficiency side, where they didn't just want everyone going full points with energy efficiency and kind of getting around the affordable and accessible unit. So that changed. The points were dropped down. We saw insurance premiums and their baseline expenses went up. The first time a couple years ago. There's been a second increase on the insurance premiums that just happened in the last start of August, end of July. We have had changes on like permits, not permits, but like lot structures and combining two side-by-side buildings to meet the minimum of 5 units, where you can no longer, there's some changes there. You can't just collateralize 2 buildings.
The big one, for those who know, that I'm more on the private space side.
Yes.
The non-approved lender payout.
Yeah, that was...
That crippled people.
Yeah.
There was so basically CMHC created a list of lenders that they would pay out. So if you went into a project with private debt, you had to go to a bridge lender before you could go to CMHC.
Yeah.
There was 3 main ones, or maybe a few more than that. There was a handful of bridge lenders that bottlenecked the entire industry. Those bridge lenders were slammed.
Yeah.
People stuck in private debt, and they couldn't get out of the private debt. Their liquidity was gone. So by the time they went to CMHC, they didn't have the liquid. So that policy was the biggest impact that I saw on my side of the business.
Yeah. I think the consensus around that particular time was around the time where CMHC's timelines were just really getting blown out of the water. And I think most people felt that they were just trying to slow down the pipeline, because they put that policy into effect, and then like a year later they were like, okay, that policy's gone and we'll now pay out anybody regardless of what it was, right? They've always had a giant list of NHA approved lenders. They just decided to no longer take out non-approved lenders. Like, I had a client where he bought a property with a private lender out in Alberta. He went through his like 12-month repositioning. We put him into, how did it go? We put him into a bridge loan with a CMHC approved lender, but because he wasn't in that bridge loan for 12 months, that was the requirement, was he had to have been with a CMHC approved lender for 12 months. He had to wait the 12 months on top of that in, bridge debt, which was another like 8.5% to 9% interest fee. So he's been in like private debt for like almost 2.5 years. I think we had put in an application first before the policy went in. Policy came in, they said no. He got stuck in the debt, and then by the time we went to go refinance again, they took away the policy and we're like, okay, now we're, no more 12-month rule, like whatever, we'll take out any sort of private debt. So I'm like, the poor guy and a lot of other investors got stuck in these projects where, to go through a BRRRR, or like, a repositioning is more the proper term on the commercial side, most of the time you have to use some sort of like private debt, depending on the building, to get in, high vacancies, whatever, right, low cash flow. Not many of these private guys are CMHC approved, or they don't like the loan size or the location that they were buying in, for whatever reason they couldn't get one of these like CMHC approved bridge lenders. But they had the expectation of, okay, I'm going to do this, I'm going to put the money in, we're going to turn it over and have a cash flowing asset. And then you get the government that comes in and then says, okay, well, we're changing the policy. And I think that's, to kind of take that piece and kind of apply it to the feelings behind CMHC is, we're seeing a lot of people now that are like, well, I don't even know if I want to go to CMHC, because especially on new developments, they're like, if I have a 12 to 24 month build time, how do I know my policy is not going to change within that time? And now I'm stuck, not being able to get the points that I wanted or the leverage that I wanted, or, for whatever it is. And then now I can't pay back, maybe my construction loan or investors or just myself and any other debt. And there is some hurt feelings in and around that. And I completely understand as well too. It's frustrating on our end when we sit down with a client and we go over a project, and then 6 months later something comes out and we're like, okay, we got to pivot now. We have no choice, right? So it's frustrating. It's now just kind of like an inherent risk with CMHC, is that if you aren't closing immediately and you don't have this filed into CMHC immediately, there is a chance something might change and it might mess up your loan down the road. And it's just kind of part of it, unfortunately.
That's the scary part about those folks that are doing deal or finance product specific investing. They're buying a deal based on a 95.5 MLI. That, I get it. That's like, if it works, it works. But you're all in on that product, and if that product doesn't come through, and there's a policy change, what's the backup plan?
Yeah.
Right? So I've always liked when I'm doing a private acquisition for somebody, a apartment building reposition, I always like to look at it at like a 25 or 75% LTV credit union exit. That's how I underwrite the exit.
Yep.
Because I know that's very realistic. There's lots of credit unions that will do that. If you can get all the CMHC above that, then I know I'm extra safe. But with this, on this exit, can you get a 75% LTV, 25-year AM, 5.5 rate on a credit union? If you can on that exit, I feel good about lending the private capital, because that's kind of the backup plan.
Yep.
Maybe you can go CMHC standard, maybe you can go MLI, but at the very least, I can get out of this private debt.
And credit unions are doing the exact same thing. Like on the construction side, if you're not going directly into CMHC construction, which there's a lot of individuals that are moving away from it and then just going into CMHC term on the back end, credit unions, even the guys that are able to submit to CMHC, they're not, they'll make sure the CMHC exit makes sense.
Of course, yeah.
But they're still underwriting it to their own uninsured option. And the difference is, 65% cost versus, what could potentially be 75% as a maximum cost for a credit union, because they're safeguarding and they're saying the same thing. Like just the temperature around CMHC is we don't know where they're going to be in 12 months from now. And if you have a project that's going to take you 18, 24 months, we want to make sure that you're not going to get stuck, at a lower debt servicing. To generalize more, the rental market is still softening, has been softening for probably the last year. Vacancies are up, right? And these are coming out of, your lowest vacancy, highest rental market. So it's down. It's not, all-time lows and all-time highs in vacancy, but when people are underwriting their numbers and, for construction projects, you could be 6 to 12 months before you're even at the point of being able to get into, you could just be waiting on zoning for 6 months, right? So when you start a process and, okay, we're going to run our numbers on a pro forma to make sure the project even makes sense to start. Here's our rents in today's market. 12 months later, you could be in a completely different environment with your rents and vacancy. And we are definitely seeing that right now across the board on construction with CMHC, and even on the non-insured side. I got some clients in Alberta that are building aplexes. The credit unions are like, hey, your rents are, $2,350. We think it's gonna be $2,150. That's what we're seeing right now when they're knocking down the rents on the projects. Some of the private lenders are doing the same thing. CMHC is doing the same thing. If you're really aggressive, not even really aggressive, it's just if you're within market rents in that region, but CMHC is seeing numbers come in lower, they themselves will say, hey, look, we're not seeing this anymore. We're seeing, a couple $100 less. That's what we're gonna underwrite the project at. So there is a lot of potential issues to come up with financing in general, specifically more so getting into CMHC. But I think one thing is, yes, it's slightly unfair for CMHC to change the policies as much as they do. Two, I think we had a brief period of real estate being so good that we weren't used to this. And now we're coming out of that temperature, and people are like, oh, this isn't, it wasn't like this a couple years ago. And it's like, yeah, you can't compare the most perfect cycle of real estate to a more normal, right? It's not supposed to be just, hey, we apply for everything and everything gets financed, right? There's going to be issues. Real estate is still an investment, right? It's still a gamble at the end of the day. It's a much more calculated and analyzed, gamble, and there's still risk to it. So I think we're getting back to a more normalized investment era in Canada, right? It's not like it was. There's a lot of people who are very bearish on Canadian real estate. There's some people who are still bullish on Canadian real estate, depending on how you want to look at it. But yeah, I think you're always going to have issues if you expect everything to be perfect and there's nothing come up, right? Like that.
Well, and what you just described to me, and I'm going through a CMHC file myself right now, and we lowered the rents a little bit to be. That's a good thing. Mm-hmm. We're protecting our downside.
Yeah.
When CMHC, a full-blown policy change is frustrating, but when they're saying, hey, we're seeing the rents come down from market, we're adjusting this now, and these are the numbers that are realistic.
Yeah.
We shouldn't be upset as an investor. We should be like, okay, cool, that makes sense. And the reality is, if the deal still works with those lower numbers and you deliver the higher rent, you have more cash flow.
Yeah.
So I think we both really came in the 2020 height of everything, where the appreciation was hiding mistakes that were being made, and that appreciation is gone. And I don't know if I'm bearish or bullish. I think we're going to be sideways for the next couple of years. I love a 3 to 5% appreciation rate. I don't want 10 and 20. I want 3 to 5%. Properties trading, I'm good with that. But being conservative in underwriting is just prudent investing, and that's how you're going to mitigate your risk. And like just to repeat myself, I get it. We're frustrated when they change the goalposts completely, but when they come back and say, "Hey, we're gonna be a little bit more conservative," if your deal doesn't work, don't do the deal. Find a deal.
Well, I mean, you can see the difference on mid-sized investors versus like your top probably 1 or 5%, right, institutional guys. Like, for anyone that's ever been to like the apartment building conference or any of like the economic forums and stuff like that, you're listening to the top 1%. You get like the Fitzrovias, the Can Reeds, all these guys, right? And over the last couple of years, their rhetoric hasn't been the environment for us to invest. No one's really trading, assets aren't moving, no one's building. And those are the guys that are obviously in a position where they don't have to, they've made their wealth, they've made their name, they can sit on the sidelines, they can make much more calculated and strategic decisions. They're not in that like FOMO type, hey, I'm building stage. They've already done that and they've made it, right? For us, like in what we see, we're like, no, it's been like crazy volume over the last like few years, right? Like everyone's trying to get in, everyone sees it as an opportunity. So I mean, it's different levels of calculations, different levels of risk for sure, right? If you're newer and your mindset is, hey, I'm going to build my generational wealth through real estate, your risk mitigation and calculations are going to be way different than, $1 billion trust fund or, REIT, right? So there's definitely different levels there. But even within the mid-level guys that are fairly successful, newer successful, whatever level, we see the difference in calculations too at different success levels in that like grouping, where I have some guys that they'll look at a market and they'll go back 10 years and say, what was the highest vacancy in Alberta? Okay, it was, or in Edmonton maybe. Okay, maybe it was like 8 or 9%. Okay, well, we're going to use that to underwrite all our numbers because we know that through an entire real estate cycle, we're going to be fine, because it might be 4% now, but in 5 years it could be 10% because that's what it was back in 2002 or whatever, right? So there are people who will do much more due diligence. Now, is that going to hurt your numbers on your own sheets? For sure. If you're comparing a 4% vacancy to 10%, yeah, your extra 6% is definitely going to knock you down a few percentages on your loan to value or loan to cost, right? Where, a more newer investor is, well, okay, here's what, my buddy was building an eightplex in the area. These are the rents that he's using. This is his property taxes. I'm borrowing some capital with an off-paper investor or whatever to help me get in. So I need to be able to pay them back to be able to hit 95. I need these rents, and I need to get my vacancy here and squeak it all out. And, it's not right or wrong necessarily. There's just a lot more risk that goes with having to leverage everything out. And I think CMHC has seen that as well too, because we've seen, MLI Select did not have rental achievement. Rental achievement was brought on. People just aren't hitting the rents at the end of the day on their projects, or, what used to take 2 months to tenant out is taking 3 to 5 months to get tenanted, right?
Lease ups are up. They're
taking longer. And when things take longer, you start to drop your rents because, hey, we just need to get something in this building now. So, maybe we're not 23, maybe we're 21 now, because I'd rather get renters in today than wait another 2-3 months to try to get 2,500 or 2,300, right? Whatever it was. So we are seeing like the I don't call it repercussions, but what could be repercussions is when you're trying to force everything through at a super high leverage and super high rent and they're not coming out. Well, CMHC is going to say, okay, to offset that risk, this is what we're going to do, is now we have rental achievement. I think it's also why CMHC made some changes to their insurance premiums. Everyone was going MLI Select. I think they're trying to push and spread that out, right? So now MLI Select and CMHC share the same, or MLI Select and Market Rent, Market MLI, whatever you want to call it, standard CMHC, share the same base premiums. Construction has its own insurance premiums now. Your top end on CMHC construction for the insurance premium is 9%. Plus probably amortization on that. Like you can creep into the 10% range on your construction premium. I think CMHC is trying to just I think they recognize there's a lot more mid-level guys that are getting in, and unfortunately, as a mid-level investor, you are more of a risk at construction.
Yep.
You don't have as much capital, and you just don't have as much experience, and those two things really dictate how well and smooth your project's going to go. So I think we're seeing some of that there as well too. At the last, and I forget what it was, whether it was economic or one of the apartment building conferences, but the head of CMHC was there, and she made a very adamant point where she wants to deleverage their portfolio. And I think we're going to start to see, I think that was already kind of the push of it. I think the insurance premiums was a little bit of a, hey, here's like a first little hurdle.
What does that mean? CMHC wants to deleverage their portfolio.
Yeah, I mean, so if you don't fully understand how CMHC is not a lender, they're an insurance company, right? So
I think that's a big,
yeah.
I've been shouting at the mountaintops for years, but I still think that's a misunderstood.
Yeah.
That they're not, CMHC doesn't lend their money, they insure the debt so the lenders can do it. So that's a...
Yeah, it's no different than your residential CMHC insurance, right? CMHC's not the lender, they just insure the mortgage, which allows the lender to give cheaper debt and more debt, because they know at the end of the day, if you default, it's insured and the bank's not going to lose their money. So that's same thing on the commercial side.
So CMHC trying to delever is CMHC wants to insure less mortgages?
Less mortgages or less risky mortgages. I think we're going to start seeing tougher times on mortgages in more rural areas. I've noticed it's probably not the right metric to use because it's CMHC construction, and everyone's a little bit less risky on construction, but I've seen had some stuff in New Brunswick, in what was the fourth largest city in New Brunswick, but it was only 25,000 population, and no one really wanted to do the CMHC construction out there. They were all happy to do the term debt, hey, finish it and come back and we'll do it, but we don't want to do the construction. And again, I don't think it's quite the right one, because construction is always a little iffy. But I think they are going to start to crack down on smaller loan sizes. And again, smaller loan size just means you're probably a newer to more mid-sized investor. And again, the inherited risk is less capital, less experience, less management. And that's just how they're looking at it, right? Is what is the risks associated with certain metrics? A metric being more rural area. You're probably not a big REIT, because big REITs aren't they're not buying in the $10,000 or the 10,000 population areas, right? They're just not. Those smaller loan sizes, newer investor, smaller construction loans, newer investor. That's their algorithm, right? That's how they figure out risk. And I think they're just going to start being tougher on those files in that area. We haven't seen it. It's been general conversation from some of the lenders that they think it's going to start to happen, but they're going to find a way to start deleveraging. And I think, if you take a look at all the purpose-built stuff that's been developed or financed in the last year or two. I know Daniel Foch had a stat, and it was I think it was 90-something% is all CMHC. The increase in CMHC uses is astronomical. It's statistically significant for sure.
It's huge. And we're hearing, I have a couple other CMHC guys I work with a lot. One of their models right now is they're going to condo developers, traditional condo developers who are sitting on SPA stuff, showing them this product, being why don't you build purpose-built rental? You've done that once or twice, maybe?
I just had a conversation with a guy. I got one project up in Penetang, and then I spoke to someone else about a project in the Guelph area, and it was the exact same thing. Home builders, subdivision, no longer makes sense to build and sell, and how do we convert into purpose-built rentals? Gives you the higher end, you get better leverage on your construction financing. You can hold the asset. At the end of the day, if you wanted to sell the projects in 5 to 10 years, whenever your term is up, you can sell them.
One selling point for these guys too is keeping their crews busy.
They
got good trades, they got families that they're supporting, and they can't build for nothing. But the product this makes sense. I don't make a big profit myself, but I make it longer term. My crew's busy. I got an asset. It makes sense.
Well, I think that's slightly different conversation. But the condo builders, do you bail them out? I think you have to at the end of the day, because there's the market is going to come back, right? The condo market is pretty much dead now, but it's not going to be dead forever. In 10 to 15 years, the condo market's going to be back. Housing is just an issue across the board. Whether the condo market is up or down, housing is still an issue. Man, we still need housing, which means we still need rentals, right? Edmonton's probably or Calgary, Alberta, Edmonton, that whole market is probably the only area that's actually hitting their target for new built rentals and homes. Ontario is definitely not. So what do? Do you let these, big developers who have the proven track record and the actual financial ability to get these towers and homes built, do you let them suffer? Like, I don't think you can, because I think they're going to remember that. I think they know the position they're in, and then when things do come back and the government's finally ready to give them some proper incentives, they're going to be like, where were you guys when we were struggling in a market that wasn't entirely our fault and we were asking for help? And now the market, you guys have fixed the market, you've dropped rates, whatever, or now you're finally ready to give us incentives. Like why should we now jump in to bail you guys out when you guys didn't want to help us out? And I could see that being a conversation, pathway that things move in, but
I love your insight on that, because I think a lot of us, a lot of people, when they think of like the big home builders, they think of these conglomerates. But like at the end of the day, there's usually a guy at the end of the table there, and he's a guy. He's the one who makes the decision, and just like everybody, he's maybe a little bit emotional about that. Like, I don't want, like, I don't trust you.
Yeah.
You didn't treat me good. I don't want to treat you good. You don't do business with people you don't trust.
Yeah.
But when we talk about these housing issues, we think of the big government and the big builders. But on the private side of it, it's usually a guy, usually a family, usually a couple, and they're people too. And if they're not taken care of in the bad times, they don't want to take care of other people in the good times.
Yeah. I mean, the brunt of it right now is like the missing middle is definitely making up for a lot, and there's definitely a place for that. I don't know if it's going to solve the issues long term, but I think it's a very niche piece of the puzzle that has to be dealt with. And I think overall, the government has to start doing more, right? I mean, we see in the States where there's huge property tax rebates and incentives, and your fees with the city, right? Like all your construction costs, like you're just blanking on the words here, but development fees, your DCs, right? Like they're huge incentives.
I got to go drop off today. I'm well aware what they are.
And we are starting to see it in some areas, but I think it's a small step. But at the end of the day, like, if you really want people to start building, you have to help them out, right? I mean, like you have to put these incentives in place, or it's just not going to be there, right? Even with home prices falling down, people still aren't buying, I think, at the level where they could, because the affordability still just isn't there, right? Rates haven't really come down. I mean, they've come down a little bit, but they're not. I think we're in a pretty normal-ish rate environment. Could they come down a little bit? Yeah, maybe. But I think it's not just the rates. I think people have just been tapped out on their overall cost of living. Groceries are up, gas is up, everything, right? Everything's up. And that's just kind of like wiping out any sort of savings they had made over COVID, right? There was all the news about, savings are up huge over COVID. Well, things got back to normal, and inflation went crazy, and that just wiped out everything. And I think that's really the tough point as well too, is just like that personal affordability, isn't there. So I think the government's got to do something to help out on the development side. Big investor, mid investor, I think put property tax rebates, drop the DC charges, make red tape less, inhibiting.
Frankly, even some of them are starting to, even some deferral on development charges makes a difference. Cash flowing that up front is a challenge when you're a mid-range developer getting everything off the ground.
Small steps, but I think there's more that really needs to happen. But
Ehren, we always like to ask, what's the hard truth? So I prompted you before, and I hope you had some time to think about it. Typically we do if you're a new investor, so brand new, bright-eyed, bushy-tailed, and then you could do kind of like one hard truth for them, and then maybe one hard truth for somebody who's, at 5 or trying to grow and scale. What's the hard truth?
Yeah, I think if you're a new investor, definitely don't get caught up in the social media hype, right? 95% down, build a 5% is a huge red flag for me when I see that. I think people associate 5% with 5% down and not like a 5% equity position, which is completely different. 5% down is more like, oh, you only need to physically put 5% in, where a 5% equity position is how much equity you're leaving in the project. Doesn't mean you don't have to put it in from the front. It's how much gets left in at the end of the day. If you look at a construction project, you got to buy the land, you got to go through at least a 6-figure soft cost, zoning, permit, studies, surveys, all that stuff. If you're buying raw land, clearing it, demolition, there's a few $100,000 that's going to go into that. You have your HST during the construction program that you have to cover out of your pocket. That you have to apply to get that rebated. You have a 10% construction lien hold back that you have to cover because that's held back as well too. Most lenders want to see at least 10% in liquidity, right, to be able to get any sort of deposits, right? If you're dealing with a builder or GCs that require deposits up front, while your construction tranche doesn't cover deposits, it covers invoices. So that $150,000, $200,000 deposit, that's got to come out of your pocket. If you have a rental achievement with the CMHC loan, that could be another 10 to 15% out of your pocket that you have to cover up front, right? You can, on a 95.5 loan that gets approved, you could easily still have to have 35% of the project costs to be able to come out of your pocket before you get that all, recouped at the back end. So, just social media, it's a good indicator of what can be out there, but just know it, like, especially on construction, but even financing of like pre-existing assets, it's not, you're not going to be able to get the exact same financing as everyone, or there's other variables that come into it, right? If you're in coaching groups and your coach is talking about financing, well, understand that your coach has been around for a while. His experience is higher than yours. His net worth is higher than yours. His liquidity is higher than yours. These are all things that a lender looks at and says, hey, we're happier to give this guy better financing because he's been doing it for 10 years. You're brand new. This is your first project. You're not going to get the same financing. So just, keep that in mind as well too, is that what you see is not always what you're going to get. And just don't always fall for all the hype.
I love that. You got to read the fine print.
Yeah.
The headline's 95.5. Yeah. And is the headline wrong? No. But you got to meet with a professional. You got to do that. So so that was actually kind of for like more than just a newbie. But
new to mid-level, yeah. It could be for anyone actually.
I know it was for anyone. Do you have anything? You started off with saying this was for a newbie, but do you have anything for like somebody who's stuck in trying to scale or trying to grow beyond? I always classify it as like guy with rental properties versus guy trying to grow a real estate business.
Yeah, I think, in my opinion, I think the residential portfolios are kind of bust at this point. If you don't already have a portfolio that you've built, over the last like 10 years, that's low debt servicing, like low leverage and still has the ability to debt service, like that's really the only way you could make residential, like sub 4 unit properties work. I think everything else, it's now, leverage still is the name of the game in multiple different senses, right? Leverage your units, right? Like having, 30, 50, 100 units and having vacancies, like you can offset that, right? We know vacancies are higher, so the only way to offset that is to have more units. If you have a 1-unit building or you have a house and it's vacant, you're not making any money. You have a duplex, one's vacant, you've lost 50%, right? So playing the numbers game is definitely how you're gonna be able to offset slightly lower rents and higher vacancies, right? Just to be able to take care of that. I think from a personal qualification, being able to rely on your asset qualifying more than you personally, as we know, inflation throughout everything is just not, your personal income is not going up, right? So unless you're making, $250,000, $300,000, you're going to be in a tough spot trying to continuously build out a personal portfolio of res properties. CMHC, it is, they're definitely a competitive product. I think you need to figure out, do you want to be a cash flow guy or do you want to be like a leverage guy, right? If you're leveraging everything at 95% loan to value, your cash flow is going to be as low as it can possibly on these properties. Now there's certain areas where it's a little bit easier, right? It's hard to compare Ontario to Alberta, right? You can buy MLI products at 95.5 in Ontario at 1.1 debt service, even with the 50-year AM, but in Edmonton, you might be 1.25, 1.3. So I guess also do your research on your market, and again, that's going to come down to as well, like, do you want to be a leverage guy or a cash flow guy? Because you can't technically get both if you're at 95% loan to value. So
right. You got to do the work.
Yeah. If you want high leverage, you're not going to have high cash flow. So
it's the pros and cons, right? So It was great to have you on here today. Really appreciate the drive down. I wish the beach was nicer for you out there. You could have, tan the.
I was hoping for like a water tornado or something.
Yeah,
I missed that week, I guess. So,
yeah. So much appreciated. Love to have you on again. We'll make sure your links and your way to reach out to you is there. I always find this funny when people say like, aren't guys like Ehren and some of the other brokers I've had, aren't they your competitors? Honestly, I don't look at that in any way. Ehren and Bill, you guys are an amazing team, great brokers.
Well, I mean, we've done stuff with you too.
That's right.
We've worked through you on your private side, and
that's
done a lot
right.
of stuff.
Anytime someone's like, I'm working with Ehren and Josh, stick with them. Like they're great. So thanks so much, Ehren. We'll make sure we'll take your links and we'll get you on here again.
Sounds good.
Okay.